Let's talk about the outlook for next year, how to position for this. Rather than going into next year going, hey, I'm a raging bull or I'm a raging bear, don't do that. Let's go into next year understanding that the bullish supports for the markets are currently present. We have liquidity, we've got momentum, we've got sentiment, all in favor of the bulls. So at least for the first quarter to first half of the year, the market looks pretty good to the upside. Fundamentals, credit, technical deviations, those type of things, those are a little bit longer term in nature. So those may not show up until the latter half of next year. And this is why it's important to keep these factors all in mind, because we could have next year both environments come to fruition. We could have a bullish first half and a bearish second half. We could have a bullish year next year and a bearish 2027. The timing is going to be the very difficult part for investors. And it could be a bullish first quarter and a bearish second quarter. I don't know, because there's going to be some event that comes along that triggers those bearish catalysts of the markets. And again, you strip out everything else, the private credit, the deviations, those type of things, those are all catalysts, because ultimately the correction will be a reversion of valuations due to a change in expectations for earnings. That's going to be the issue. Whenever you have corrections in markets, whether they're a 10% correction or a 20% correction or a 30% correction, it's always just a function of repricing markets for a change in expectations over earnings. That's it, no more, no less. And everything else, all the headlines, are simply the catalysts that are causing that change in earnings expectations. So you have a bullish first half because of momentum and expectations are still bullish. And then somewhere along the way, something happens, whatever it is, that changes those expectations. And that's how you get the bearish kind of second half of the year, or however it works out. And again, timing is going to be the terrible consequence of this, trying to get it right. But this is why we need to go into next year with kind of a basic game plan of just how to navigate this outcome. So maintain some diversified equity exposure. It's okay to have the Mag 7. It's okay to chase some AI technology stocks, but have some defensive holdings in your portfolio. Have some bonds, have some kind of defensive stocks, your boring Berkshire Hathaways, your consumer staples, things like that are going to hold up if you start getting a bigger reversion in the markets for some reason. Keep some cash. Cash gives you optionality. So when something happens, I've got cash to buy some assets cheaper. I got an email like, can't you just pick a side? You're always like both sides of the fence. Yes, markets go up and down. Yes, absolutely. They go up and down. And so our job as investors is to navigate that. I'm not smart enough to tell you exactly when the markets are going to correct. What I can do is understand when they are starting to correct, I can reduce exposure. And then when they stop correcting, I can increase exposure again. Again, if you're going to see any type of event that leads to a very big risk-off catalyst, it's going to show up in the credit markets. Pay attention to credit markets, watch credit spreads.
Catch me daily on The Real Investment Show. The link is in the description.